The Indian rupee sank to a new record low on Monday against the US dollar as the greenback's unabated strength wreaked havoc on financial markets across the globe amid fears over more aggressive monetary tightening. The local unit weakened by 63 paise to end Monday at 81.63 per dollar against 80.99 at the previous close. The rupee has depreciated 9.7% against the US dollar year to date. On September 21st, the US Federal Reserve not only hiked rates by 75 basis points, taking the total tally of rate hikes since March to 300 basis points, but also hinted at a longer monetary tightening cycle than earlier expected. Since then, the rupee has gone from one of the world's best performing currencies to one of the worst. The dollar index, which has gained a massive 22% so far in 2022, surged to a fresh 20-year high early Monday. The rupee has depreciated 2% versus the dollar since September 21, ranking among the worst performing emerging market units. Over the time period, it has fared worse than 14 other emerging market currencies, with only the South Korean won losing more versus the US dollar. Prior to September 21, the rupee had outperformed many of its peers, primarily on account of heavy market interventions by the RBI. The RBI has aggressively defended the rupee through sales of US dollars since the Ukraine war broke out in late February. India's forex reserves have fallen by almost $100 billion from their peak of $642 billion in October 2021. As on September 16th, they have dropped to a near two-year low of $545.65 billion. Some part of the fall in reserves is due to revaluation changes. The import cover provided by the reserves have reduced to 9 months from close to 15 months a year ago. Let us go to economist Rahul Bajoria for more.
Our expectation since the month of June still remains about $115 billion of current account deficit for this current fiscal year. Now, the drivers behind that continues to be, India's relatively strong growth profile. So you should see some correction in the trade deficit in the next few months, but then it will still ensure that, we will have a overall current account deficit, which is north of 3% of GDP, which is what, is seen as a sustainable level. Commodity prices in local currency terms are still about 20% lower from its peak levels. But then what we are not seeing right now is basically the pass through of these lower imported prices into retail prices, right? Both private companies and the government will try to recoup some of the losses that they have had. So you can think about it as that earlier when prices were going up, there was margins were contracting. Now the margins are again widening, sort of, which but eventually it will start getting passed on. So we think that next 3 months, that bulk of that pass through should sort of come through in the final quarter of this calendar year. So basically October onwards, we will see inflation coming back within the target band of the RBI.
The rupee dropping to a record low may be a mixed bag as far as exports are concerned. If rupee's depreciation continues, Indian exporters stand to gain. However, the gain would have been much more if the Indian economy was less import dependent, experts said. As a result, products across segments such as petroleum, gems and jewelry, and electronics may not gain much as they are import dependent. Besides, there is always a risk of imported inflation if the rupee falls too much. As India is 85% dependent on imports to meet its oil needs, a weakening rupee will make its purchases expensive, further fueling inflation, which has remained above RBI's upper tolerance band for 8 consecutive months. But oil and other commodity prices have eased from their peaks. Nevertheless, ICRA's chief economist Aditi Nair said that a depreciating rupee will partly counteract the benefit of lower commodity prices on inflation. India's trade deficit more than doubled to $28 billion in August due to increased crude oil imports. Imports rose by 37%, while exports rose marginally by 1.62%. This puts pressure on the current account deficit. Pranab Sen, noted economist and statistician, tells more.
The reason I think the RBI thinks that what is happening is a temporary phase is because I think they do expect the global prices to come down. And so what they're trying to do is they're managing the rupee to avoid a situation where commodity prices come down, but you've depreciated so much, the landed price in rupees has actually gone up. So the whole thing, both the decision to manage it is contingent upon your expectation that commodity prices will come down, and we just have to ride over until they do. Right? But there is another dimension, which is that today the current account deficit is running above 3%. So that seems to suggest, and this is not just a price problem. There's a problem with volumes as well. Import volumes are high. And that is a more structural problem. And that may not necessarily be temporary. So you have to segregate those two issues. How much of your current account deficit is driven by high commodity prices, which will come off later. But how much of it is being driven essentially because you're importing too much? For that, you need the rupee to depreciate.
Economists at HDFC Bank expect the RBI to continue with significant intervention to stall rupee depreciation pressures, especially as and if it moves towards 82 levels. According to them, the RBI has ample forex reserves, and the recent drawdown in reserves needs to be seen in the context of the significant build-up over the last 2 years. The RBI does not want the rupee to depreciate so quickly that India loses out on the benefit of lower crude prices in a significant way. But most currencies, including rupee, have depreciated due to dollar strength. There may be an argument, therefore, to let the rupee depreciate further to preserve India's export competitiveness relative to its trade competitors. The central bank has a tough balancing act on its hand.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.